folks spend too much time on reserves. The number one goal should be shots on goal.
Hello, and welcome back to another episode of the Data Minute Podcast. I'm your host, Peter Walker, Head of Insights here at Carta. Today is a pretty special episode. For the very first time, I'm having on a founder and CEO, Anubhav Srivastava, and his company was recently acquired by Carta. It's Tactyc.io, now part of the Carta family, and it is the premier tool across venture funds for modeling, forecasting, and portfolio management. I am absolutely thrilled to have Anubhav on board for a couple of different reasons. One, he's a super smart guy. Two, he knows more about fund modeling and forecasting than basically anyone else that I've ever met. And three, Carta data can become such a powerhouse tool inside of his app. So the fact that we are now one company is amazing. In this conversation, we actually had a couple of different sides. On the GP side of the conversation, we talked about reserve ratios, we talked about recycling capital, we talked about forecasting both at the initial moment of building your fund and throughout the lifetime of your investment strategy. We also touched on why LP influence can have some undue and unforeseen consequences on your fund metrics. We then pivoted to what it's like to get acquired. So if you're a founder listening in, stay for the end because Anubhav has some wonderful advice about how you know it's time to give up your dream as the founder and join something bigger. And it was just wonderful to hear him talk about that whole process. Really excited for you to learn from Anubhav. Let's jump into the conversation now. Anubhav, thank you so much for being here, man.
Likewise, thank you so much for having me. I've been following your content for a long time, so
thank you.
It's great to be here.
You are the very first Cartan that I have had on this podcast, and we are super excited for you joining the Carta family. Congratulations on the acquisition.
Thank you so much. Feels like it's coming home.
Yes.
Been following Carta, been involved with Carta for many years, so it's great to be finally here.
Amazing, man. So give us a quick potted overview of Tactyc and like what is so exciting about the platform.
Yeah, so Tactyc is the first forecasting and planning software for VCs. And I guess before we get into that, maybe a little bit of history on how I even came about this.
Please.
So I worked as an investment banker in New York.
I'm so sorry.
Yeah, I know. I am too. Then worked in venture capital myself. Probably spend more time than is healthy on Excel, spreadsheets, financial models.
Sure.
And the first version of Tactyc was actually not really VC related. I'd put together, for some reason, I had reverse engineered Microsoft Excel into Python, and I put it up on the web server so we could ingest any Excel spreadsheet and make it into like an interactive dashboard. That was the first version of Tactyc. So you could put like a DCF model, you could put like a valuation model and play around with different levers on a browser.
And that was for investment bankers?
It was for
For you?
FP&A, investment bankers, yes.
Yeah.
We went to Goldman Sachs, Morgan Stanley. They're like, hey, would you guys want to publish your equity research reports on these dashboards?
Yeah.
And they're like, this is really cool, but you know what? We don't work with a one-person company. So like, sorry.
Yeah.
Well, on a Friday evening, we published a venture portfolio construction model. By Monday at 9 a.m., I had 300 GPs emailing me on my inbox saying, we don't care about the rest of your platform. How do I buy this one dashboard?
So why do you think that hit so well? Like what was it about the portfolio construction that touched a nerve?
One, it's really hard. If you're doing it right, it's hard because it's a probabilistic model. It's not a very simple multiple type of calculation. If you're really doing it right, then you have to think about graduation rates, timing assumptions. And frankly, most existing spreadsheets in portfolio construction are far too simplistic. So when they actually saw something that looked good, was easy to manipulate, and could be shared with an LP, it was like, I just need this. This is going to solve like 3 weeks worth of work for me in 10 minutes.
So were they already thinking at that level of sophistication, or do you think the tool actually helped up-level their thinking as well?
It definitely helped them up-level, specifically around things like reserve ratios. What I learned through the journey is GPs came in with a very specific set of ideals of what a venture fund should look like. I'm a $100 million fund. I'm going to have a 40% reserve ratio, 40-50 shots on goal, and I'm going to get to a 3x TVPI by the end of it. Like that's their, model.
And they were getting those numbers from friends?
From friends. My friend, the other fund in the last 3 years with this vintage has done that.
Gotcha.
And then when they would actually run the numbers, specifically around like I'm a AI back startup, or I'm going to back AI companies, or I'm going to back fintech companies. And now let's look at the graduation rates for those sectors. That 40% reserve ratio may not actually pencil in anymore because the graduation rates could be much higher or lower. And so it's sort of to make people question their own assumptions on what an optimal construction plan look like. So that is what we went out to the market with, that we force people to do to level up and also simplify the construction process. Of course, the next piece of feedback we got is construction is great, but I want to update this model with my real deployments. And we actually went out and worked with about 30, 40 actual funds who were doing forecasting and planning during their course of deployment to take a look at what does that workflow look like? Why do you even do forecasting and planning? Because FP&A as a function exists in pretty much every sector in the world except VC. Why is that? And we realize it's like, again, it's difficult for people to do. These are probabilistic cash flows. So we then layered in that module and we reverse engineered, frankly, a lot of this best work that we were seeing out there. And then people asked us like, hey, can we track revenues from our companies, KPIs from our companies, all in this one place? We did that.
Yeah.
And 3 years later, Tactyc is where it is today.
It's unbelievable, man. I mean, there's a couple of overlaps there with Carta history that make it such a beautiful little synergy. First and foremost, the way that Henry, our CEO, talks about Carta as basically a system for finding places where spreadsheets are being emailed back and forth and turning that into software, which I'm sure that resonates quite a lot with you.
Absolutely.
When you're talking to these GPs, so there were kind of 3 levels there, which is 1, help me think about the assumptions of my fund before I get started. 2, help me then reforecast as new data is coming in. And then the third part, which is I'm having trouble getting good data out of my portfolio companies. Let me make that easier for them.
Yeah.
Which of those 3 things do you think is the most surprising for GPs? Or because when we talk to them, I think a lot of them are thinking that once I have information rights, this will be a simple process to get data out of these portcos, but it almost never ends up that way.
So of the 3 things, actually 2 and 3 have been most enlightening for me. And I'll start with the third one first, which is the KPI stuff. Data collection is a problem, but it's not the problem, I think, in this portfolio management space. Sure, even if you solve the data collection issue, let's say you had a perfect system that would get all the revenues from all of your portfolio companies. What we came to realize is most GPs don't know what to do with the data once it gets there. Like, what do I do with all of this other than just putting it in a report?
Yeah.
Do I do benchmarks against this? Do I try and figure out where my problem spots might be so I give more attention to them? There's not a lot of good framework on what to do with that. We in Tactyc solve for that. At Tactyc, we have a data collection service that of course collects data, but we also acknowledge that that is a difficult problem to solve, and we are going to work on that, but we're never going to get 100% success rate in data collection. Sure, there's always going to be leakage there, but at least the data you have, well, what are some interesting analysis you can run? So again, we went out to the market to see what are some of the best investors in the world actually doing. There's an interesting one that we've learned, which is called a fund as a company analysis. If the fund were a single company, what would its average revenue be? What would its average cash balance be? And when you look at that company, would I invest in that company? So it's a great way to kind of gut check the health of your entire portfolio. Really simple stuff to do. And most of these things are pretty simple. So we kind of crystallize that in the software. Another one is like, okay, can I calculate or evaluate? I'm collecting revenue from my companies. I know their valuations. Let me calculate a valuation multiple of my portfolio over time. And now, am I overvalued or undervalued relative to the market? Is my fund overvalued or undervalued? Again, simple to do, but these are some like higher level insights you can get from the data that you've collected.
Do you think that most founders or most VC managers, I should say, believe that a lot of what matters is contained within the financial information? Or do they think, look, as you mentioned, even if I have perfect financial information for every one of these portcos, the stuff that matters is in the board deck or in the conversations. Like, it doesn't actually exist in a database.
Yes, I completely agree. It's the non-standard metrics sometimes that matter more.
Right.
Revenue per employee might matter more than just like a...
Certainly matters more today
Yeah.
than it seemed to in the last couple of years.
Exactly. More than just like a raw revenue number or a raw number of employees number. So again, comes down to the analysis and digging into exactly what are some of the hidden levers there. But then the second piece, which is like forecasting planning on its own, we created a whole new category here with Tactyc that every venture fund should do forecasting and planning. And why is that? And the reason is we realized that the folks that were doing this were just making better decisions when it came to reserve planning, when it came to capital call budgeting. How much should I recycle? Recycling is a very difficult topic, and we can definitely go into that. Most GPs end up like overestimating the amount they might recycle. And if you're doing effective forecasting, you can avoid that situation. Um, and so when we saw the hit rate on the reserves, so in Tactic, we calculate a follow-on multiple, which is what is the expected return on every $1 of reserves that I'm putting per company. And when we backtest that, we saw that the firms that really did well were actually computing this multiple, and they were using very effective forecasting techniques to make sure their reserves are deployed towards their best performing companies. You can only do this stuff if you have a framework of forecasting.
Right.
But we also saw that most emerging managers out there, or even some of the more established funds, they couldn't do this stuff because this is all spreadsheet stuff. And so that ended up being a pretty big unlock for us when we crystallized that in the software. And we said, hey, you know what? This is what the best fund managers in the world do. Day one on your fund, you are empowered with this information.
Yep.
That was like a big unlock for all of them.
Absolutely. I think that there's something magical about watching, you have the trial period where you can just kind of go in and set up your fund assumptions. And some of the ones I've been playing around with them for a couple months now. And recycling is one of them. Reserves is one of them. But then like follow-on strategy as a concept is something that has come up a lot with VCGPs that I'm talking to in regards to the questions that they're getting from their LPs today.
Yeah.
Right. So whereas in 2020, 2021, 2022, maybe it was, look, we're going to do some fast follows because these companies are so hot and we gotta maintain our ownership, right? Like these are rock stars.
Yeah.
And now the discussion around who receives that follow-on check and why, I think has gotten a lot more nuance. So like, what are some things that kind of trip GPs up when they think about reserves and recycling?
So I'll just preface by saying this is my opinion.
This is a fact.
Based on data that I've seen, but it is an opinion.
Yes.
And I'll also say that true alpha is out there if you differ from the consensus. So I'll just say that up front. Because
we should have that as the disclaimer to the podcast.
Yeah.
I feel like that's great.
Yeah.
I'm gonna just snip that out and put you on the top of the podcast.
Yeah. So you can hear this consensus, but if you differ from it, that's totally fine as well. So my view on early stage venture funds is folks spend too much time on reserves. I need a 40% reserve ratio, but I'm a seed or a pre-seed based fund. The number one goal should be shots on goal. It's a power law environment still. It doesn't matter how much you reserve. If you don't have enough shots on goal, you may not get that return anyway. So our math and our data has said that number for an early stage fund, there is actually a number. And in our heads, it's about 40 to 45 companies you need in your portfolio to get that critical mass.
So that means, if you're doing the math working backwards from the check sizes, you can't have a 40% reserves. You can't have a 30% reserves.
Exactly.
Probably.
Exactly. Most funds can't get to that.
Yeah.
If you have, then you're not optimally deploying your capital.
Right.
You might still luck out with the companies you have invested in, but if you're truly being fair, then you need a bigger volume of companies to be investing in. The second thing with reserves is folks come in saying, I want a 1-to-1 reserve. Well, a 1-to-1 reserve, if you think about it, it actually means, especially for early stage companies, it means for every $1 of initial check, I'm reserving $1 of follow-on. I am implicitly saying I almost need 100% graduation rate for you to get to that 50-50. If you're an early stage investor, you're not going to get 100% graduation rate.
If you're an early stage investor and you have 100% graduation rate, please reach out. I'd love to be an
absolutely
your fund. Yeah,
absolutely. In reality, as you know better than I do, it's about a third of companies that make it from pre-series A to A.
Yeah.
And so if you end up with a 50% or 40% reserve ratio, you are reserving far too much than you need to. That is the second thing that we push people to kind of ask that question. Is the 40% number actually founded on
Is there emotion tied up in that 40% number? Like, are they kind of really wedded to it? Or when you lay out a logical case, they're like, oh, okay, no problem. Yeah.
When they see the more foundational assumptions, they recognize it.
Okay.
I think it's just coming from institutional history. This is what my friend did, that whole thing.
And are the conversations that they have with LPs materially different if they propose a ratio that is kind of out of whack with what the other funds are doing?
I think LPs get it, actually.
Okay.
I will say LPs Having said that, LPs work with pattern recognition. So when they see a portfolio construction plan that deviates from the pattern, it will make them ask the question. But LPs are also used to seeing low reserve funds and high reserve funds. But of course, it has to fit into that broader category of which stage are you investing in.
Yeah.
And as long as, if you're a high reserve fund, but you're a pre-seed investor, that may not, and you have a 20 portfolio company that is going to fit outside the pattern.
Sure.
So I think LPs get it for the most part. We haven't seen a lot of pushback from the LPs, and especially when they're presented with assumptions like this that are founded on reality.
Yeah. And I'm sure that part of the reason why Tactyc is useful to the GP isn't only to concretize their thinking, but to be able to show it demonstratively to the LPs themselves and say, look through our assumptions and we can have a discussion about which one of those seem off to you.
Exactly.
Yeah.
Exactly. The other thing about reserves is, okay, we've talked about portfolio construction. Now I'm deployed. And now I have to pick between, how much should I reserve?
Yep.
One. And then two, when it comes to deploying a reserve on an e-commerce company versus an aerospace company, how do I compare them? So two analysis we've seen. The first one is, as you're reserving capital for a company at the point of investment, it should be based on the upside case, downside case for this company. The TAM is different, execution risk is different. You risk weight all those probabilities of scenarios, and you assign a reserve into each of the scenarios. At the end of the day, you do a risk weighting of that reserve ratio across all the scenarios based on the probabilities you've assigned to them. Again, a little bit nerdy here, so in Tactic you'll see
full nerdy. Come on, do it.
So you'll come up with a number there, which is, here's my risk-weighted reserves number for that company. And over time, as you get more data from the company, you develop more conviction, or maybe you lose conviction. Those probabilities can shift and move around, and your reserve number is going to move around as well.
Right.
Then you compute what my follow-on multiple is, which is what is the expected return on the next $1 into that company. And it's a very simple math. It's basically saying, what do I expect the exit share price to be divided by, what is the share price of the next round divided by the exit share price? Really simple. But once you have that follow-on multiple, now you have a marker that enables you to compare an e-commerce company with an aerospace company. And I'm not here to say that this is the way to do it. It's not prescriptive. Reserves at the end of the day is informed by subjective opinions. I love the founder. I love this industry. I like the problem they're trying to solve. And there is validity to that. But if you're truly trying to be objective about it, then you should also try to answer the question, well, is my reserve consistent with the thesis on this investment, purely on a numerical basis? And at the end of the day, reserve decisions at the best funds that we see is almost like a new investment,
right?
Where they go through a diligence process. There's a reevaluation of the investment thesis. What is the return on the next dollar I'm putting in? All of that comes together to come up with that reserve number.
Do you think, and this may be not data that you've looked into yet, do you think that the quality of decision making around the initial investment or the reserve investment which one has a bigger outsized impact on the fund returns? Because there's this theory around venture fund returns that concentration is a huge part of maintaining ownership in the right companies, and then those becoming the power law outcomes that you need.
Yeah.
But it sounds like maybe you are much more rated to the initial decision than the follow-on.
If you want to be an outlier, then two things have to go right. You have to go right on the initial,
right,
and you have to go right on the follow-on.
You have to be right more than once.
Yeah,
yes.
Yeah. So which means to get to a 20x fund or a 10x fund, TVPI, like 10x TVPI fund, all of those decisions have to be right.
Right.
If you go right on the initial checks, but you falter on the reserve checks, you can end up with a 3x fund.
Right.
That's totally fine.
Yeah.
But you can do the opposite, of course, which is like I screwed up on the initial checks, but I'm correct on the
following on into not great investment.
Exactly.
That's not so you get different thing.
Exactly. So you can accentuate, emphasize, heighten, magnify your returns if you get both those decision points right.
Gotcha. All right. Flip to the LP perspective for me for a second. What, when you're talking to LPs and they are looking across these venture fund models or portfolios or constructions, what do they wish more GPs told them? Or what are the things that they really love that they can only find from you?
What is the power law for your fund? It's a really simple question, like what is the distribution of the exit multiples that you're assuming in your portfolio construction plan? What percentage of failures are you assuming?
What is the hypothetical power law of your fund?
Hypothetical power law of your fund, yeah. And because sometimes, funny enough, if you look at spreadsheet-based construction models, there is no power line. It's like it's a flat line. And it's like, well, guys, we are in a power line environment. So like you do have to assume that most of your portfolio is going to fail. And so we've seen LPs stress test that number. Like, okay, what are you assuming in terms of your failure rate? Timing. When am I going to get my capital back? TVPI is great, but I need DPI. So when am I going to get it back? How are you giving me comfort that this is going to be between 5 years or 7 years?
5 years or 7 years.
Could be more. Yeah.
I hope it's,
I hope
more. It's not many of the plans. Yeah, at this point.
And then recycling.
Yeah.
There's a big topic on recycling. What should that be? How much should that be? Are you being overly aggressive on recycling?
What are the big like pillars of that argument you'd like?
So recycling is, I think, understood sometimes. There's two forms of recycling that we've seen in the market. There's your regular plain old vanilla exit recycling.
Yeah.
And then there's what's called the management fee recycling. And that is where we get into kind of like confusion. Exit recycling is simple. Anytime you get an exit, some percentage of it, sometimes all of it, can just go back into a new or a follow-on investment as opposed to going down to the
reuse that capital.
Reuse that capital, exactly. Management fee recycling. It's a bad name, I believe, because like it's a misnomer. People think, well, I'm not getting my fees. Instead, my fees are going to pay the investment. That's not true.
Right.
You're still recycling from your exits itself, except you're just capped up to the point of fees that you're going to take. So you're still getting your reinvestments from the exits, and so that sometimes creates a point of confusion. But the biggest thing about recycling is it depends on timing. For an early stage fund, your first exit might be year 7, year 6. By then, you are well past your initial investment horizon. You are maybe even almost eating into your follow-on horizon. You may not have enough runway there left to be able to use that recycling capital. And so you may not end up actually meeting the 120% recycling ratio. And that is something that the good funds are able to do that.
Yeah. But what happens to that money if they're not able to recycle it? They just pay it out.
It gets distributed.
Yeah. Okay.
Yeah, which is why a lot of funds don't end up meeting that 120%.
And LPs are, perhaps it's not what they expected or not what the GP said that they were going to do initially, but I'm sure that they're not that angry about getting DPI.
They're not that angry about getting DPI, but when they're looking at a portfolio construction plan and they're seeing like, oh, you're already assuming you will be able to get 125% of, it's like, well, we should stress test that a little bit. Like, is that really true?
Do you see GPs that kind of make maybe hasty or rash decisions? They say, look, I've had an exit. It's at year 5 of the fund. I'm like at the very end of my actual investment period here, but I'm just going to try to get this out as quickly as possible because I want it in a new bet or I want it in a follow-on. Right?
Absolutely. Yeah. Aggressively getting an exit, sometimes manufacturing DPI.
Right.
Like using the secondary market to actually create some artificial sales so you can actually put that in the recycling. And there's actually an interesting case study of great clients of ours. We've learned a lot from them. And they actually do this where they, on one of their funds, they were running an analysis on if we sell 25% of our portfolio in the secondary market today, sure, I lose some DPI relative to if I had held this investment all the way, but I also collect some IRR because I'm getting some cash flows up front. So, well, what is a tipping point? What is a minimum valuation? I can sell the company today, so my IRR is actually accretive relative to what it would be if I just held that investment. And by the way, I'm going to recycle this back into another company.
Sure.
Non-trivial thing to do in Excel. By the way, we've crystallized that into Tactyc, so you can do this in one click. But you can actually see the minimum valuation for each of your companies today. And some of the companies are actually at a discount relative to their last valuation. So you could be in the money today sitting on those investments if you were to just sell them in the market. Now, I'm not saying this is a good strategy, that everybody should be going out there and manufacturing DPI. But these are some levers that sometimes LPs may push GPs.
I mean, the idea of LPs pushing GPs has become a constant topic of conversation lately. And you hear both sides. It's, from the LPs, it's like, well, we're not pushing, we're just asking around the timing. And there was an original plan, and now we're on a very different plan given to where things are. Then you talk to GPs and they're like, yeah, we're getting pushed in all sorts of ways to do things that we don't think are healthy for the beneficial lifetime of the fund. So
exactly. On that same end, I would say LPs also, if there's a deviation of check size strategy through the life of the fund. So like I sold something on the portfolio construction, like, yeah, here's my plan on check sizes and reserves, but I got a great deal. I'm going to invest a lot more in that. I'm going to deviate from my plan. LPs do see this a lot, and they will push you like, well, that's not really on brand for you, on thesis for you. Why are you so beyond? Why are you deviating from plan on that? So um, again, in Tactic, we actually try and show you, are you deviating from your plan in your check sizes, reserves? And if you were to do that, what would the impact on your TVPI trajectory look like in time? And for the GP to be better informed that, okay, well, I did deviate. Now, how do I course correct back into what I was supposed to be? So yeah, we do see LPs pushing a lot of that too.
It gets into the cultural relationship conversation between GPs and LPs, where when we have talked about all of these different MOIC, IRR, blah, 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 for the first 4 or 5 years of the fund, and the LP goes, the sophisticated ones at least, they go, look, we understand, right? You may not look like a fund returner now, and you may end up being a top performer later. We get that. We want to know why you deviated from what you said you were going to deviate.
Yeah.
And what it comes down to when we really dig into those conversations is, do we trust that the GP had a great reason? Or is it, I just love this founder? And then you really are just talking about trust.
Yeah, that's
right?
a
And
good
so like
point.
the numbers are the bedrock of all of these rational discussions, and they can illuminate so many of the talking points. And then when you scratch 2 layers deeper, it's like, do I trust this GP?
Yeah.
Are they making the decision that I would have made? It's really interesting to come across those like parts where the venture market is really just all about trust at the end of the day.
Yeah. Have you seen that borne out in your data at all in terms of LP, GP? What are the type of questions that get asked?
Yeah. So we, in our discussions with a lot of LPs, the things that they are trying to understand is, one, they're asking a lot more questions now about the underlying portfolio.
Yeah.
So not staying at the fund level, but trying to get much deeper into like, okay, well, what is the trajectory for this individual portco company, et cetera, et cetera.
Yeah.
So some of the KPI stuff is probably going to be incredibly helpful. The other thing that's happening is they're just kind of, as we know, if you look at the fundraising from the last year for VC funds, like so much of it, always a power law industry, but concentrated in the biggest billion-dollar funds.
Yeah.
So the outperformance of an emerging manager, I think, is one of the biggest questions that we get from LPs. Like, can we help prove it? Do we have any data to deny it? We haven't produced any data either side yet, but it's the thing that we get asked all the time.
That's one we should work on together.
That sounds good. Yeah.
Absolutely, because we certainly, you're in house. Yeah, exactly. Because we certainly have a lot of emerging managers, and we've heard that thesis as well, that
Yep.
the TVPI is higher on that. So that's something we'll get out in time.
We promise at some point. No date to be decided. But look, man, I wanted to maybe wrap up our conversation here by pivoting to, you're obviously steeped in the VC world, but you are first and foremost a founder whose business just got acquired. So what's it been like during an acquisition? People are super excited to hear about like what is the nitty gritty of actually getting a company acquired.
It's a lot. It's mixed feelings. It's emotional. There's a sense of achievement, all of that. The way I operated the company is very non-traditional. We were venture-backed, but I operated this as if I had no money. We raised very little capital, and less than 2 million. And I used up about 300K before we got to profitability. After that, I was razor focused on, frankly, staying profitable. SaaS margins, and my number one focus was, we invested $0 in sales. The only thing we invested was time with our customers. That's it. And the number one thing I did was trying to keep our customers as happy as we could, and they did all the sales work for me with the referrals and word of mouth.
We've heard a lot of that. Yeah, they did a lot of that sales work for you for sure.
That's exactly what I thought we should be doing. And so I think the biggest thing is I developed a lot of great relationships with the GP community, with the emerging manager community, which I'm always grateful of. And then I hit a point where I realized that for Tactyc to truly spread its wings, we needed to be part of a bigger company. Fund modeling and portfolio management as a whole has a certain trajectory, but for us to truly accelerate that trajectory, we needed data. We needed to be part of an ERP ecosystem like Henry has played out. And so fitting with Carta just made sense. In all candidness, this is not the first time Carta had reached out to us.
Yeah.
Carta's competitors have reached out to us, have given us offers. I've said no before. because I felt like I still have a bit more left in the tank to see where I can take this. But then finally, when Henry and I actually discussed this here, it felt like, yeah, this is the right time. We're hitting that inflection point where Carta could truly accelerate this. But at the same time, it is emotional. It is something I built on the weekends and at nights, working till 3 in the morning, searching for product market fit, existential crisis every Saturday morning. Like, am I doing this right?
Like clockwork.
Yeah, exactly. And I still have it.
Sure.
So it's been quite the ride. I will say this. I've never been the smartest guy in the room. I've never been the smartest engineer. But I ended up in a place where I did a lot of finance work, and I knew just enough coding and software that I could like piece together this weird mishmash of a niche that strangely only or I was one of the few people that could like figure that out.
Sure.
There were better engineers than me. There are better venture capitalists than me. But I ended up in the sweet spot where I could see something here that like, okay, I could probably build this. And I'm thankful for that, for being in that overlap zone.
I think you're giving yourself a little too little credit there, but I get it. Maybe going back to that point that you just made, which I think is really fascinating for founders, where you kind of looked out and you said, I have a feeling that Tactyc needs to be part of a bigger something. How, like, were we using data? Was it kind of instinct to make that decision? Like when you talk to other entrepreneurs who are maybe at companies that are doing well, but they don't know what the next phase looks like, how do you give them any advice on that?
It was the customer, because I saw where Tactyc fit in the workflow of my users. And they would be looking for data from Carta to put into Tactyc. They would then get a report out, and the reports would be supplemented with reports from Carta.
Yeah.
And so it's like, wait a second, the way the user is using this is actually part of Carta or maybe another system. And how cool would it be if, or how imperative it would be if we were all just one software?
Right.
Because the user kept telling us, I don't want to maintain 2 systems. I just want one system. Sure.
Listen to your users.
Exactly.
Always agree.
Listen to your users, but not all the time as well.
Sure. Yeah.
That is another thing I learned is like, there's a lot of like fortune cookie wisdom out there on how to build a company, of course. And one of it is like, yeah, listen to your customers, which we have. But if I truly built a product based on what I heard from the customers, then it would be an unusable product. Because everybody wants, their own little thing. And we had to eventually figure out like, okay, well, what makes sense along with the vision for what we wanted to build. So it's been a great journey, and I look forward to putting all of those into Carta and seeing where we can take this.
Super happy you're here, man. Thanks so much.
Yeah, likewise. Thank you so much for having me, man.
First of many.
Yeah, absolutely.